Let's continue the conversation with Rebecca Walser, president of Walser Wealth Management. She joins me now here at the desk. Rebecca, thanks so much for joining us.
Thanks for having me, Carolyn. Great to be here
in person.
Thank you.
So we were just gearing up for the big reports after the bell today with Jenny Horn, and obviously big tech has really been a standout for most of the year. Do you think that's going to be the case for earnings season as well? Is it going to be big tech are the winners?
So far, I don't see anything that's going to create an outlier this quarter, and we know that Microsoft obviously up to year-to-date over 37%, Google even more, so Alphabet. So, we're seeing that big tech has carried, but, obviously, Carolyn, I'm really excited about this morning. The earnings season's beginning in earnest with GE having a double beat, 3M having a double beat, GM having just beat. I think GM had one miss, but the point is that it's getting we're seeing more breadth now. It's going to the industrials. It's not just in the tech. So I can't imagine we're seeing positive from industrials in this environment that we've had, in this macro environment that we've had since 2022, that we're going to have any surprises on the tech side.
But here's the question: is it the bar has been lowered enough that these companies are able to beat, or is it they're actually surprising to the upside because they're in a strong environment here?
Well, I think it's both, actually. I think you're 100% right. We could definitely make the case that as they saw that cost of capital was getting more expensive, and then that their savings were going to have to be leveraged, and that we were having banking, lending tightening and going into recessionary times. That's always happening. Then you could see, they lowered expectations, absolutely. But even from those lowered expectations, we are having beats that are surprising. And so I do think it's both. I think they've handled it well. The business environment has handled it very well. And also, we're really benefiting from both the German manufacturing crisis and the EU and Asia Pacific, and all of those dollars from those investors are saying, where's the money, where can I get it? And a strong dollar is pulling those investments over, so that's also really helping.
Okay. Microsoft and Alphabet, obviously AI is going to be really the name of the game with those companies. But at what point do you think the market is going to be more show me, don't tell me? How much do they want to see the strength of AI reflected in the numbers?
I think it's going to be fast, because look, Carolyn, if you look at Microsoft with OpenAI, right, and ChatGPT, they are already seeing such an increase in downloads and people starting to use to write their text messages and their emails. And so the monetization piece has to come. But as far as actual breadth of acceptance, it's becoming pretty mainstream. And it's going to be its first to its market. It's going to, Google and the others are going to have to play catch up. Because I'm not saying that they can't, but I am just saying that this is first to market, and it is becoming widely distributed globally now. People are starting to leverage it. So it's the monetization of it, just like Facebook and social media forever. How do we monetize this? That will come. But I think that people are very keenly interested in what's going on with AI.
And NVIDIA, obviously the one to beat this year in terms of the AI play.
Unbelievable.
But now NVIDIA going after Intel in the PC chip market. So not necessarily just focused on AI, also now focused on PCs. How much market share do you think they can grab?
I mean, I think Intel has got its handful. NVIDIA has $16 billion of free cash. Their debt is only $9 billion, so they have so much potential. This is July of this year. This is after $10 billion of buybacks. This year they have another $3 billion that's authorized through the end of December, and they have another $25 billion that just got authorized by their board that has no expiration. So they have so much ability to raise and to invest, and they're going after the PC market, because what's happening, this is all stemming because Microsoft is trying to keep up with Apple. Apple started using these ARM-powered chips that save battery life, process AI processing better, and so Microsoft's like, oh, we want to keep up, and so they had an exclusive agreement with Qualcomm from 2016 but expires next year, 2024, and they're asking NVIDIA to step up and say, hey, start producing these chips for us. So that's a whole nother frontier for them.
So you started to talk about the breadth that we're seeing in terms of the earnings beat. Do you think that can expand into market outperformance here? Because that's been the one thing sort of missing from this market, is just overall breadth of the rally. Do you think that this earnings season will be a positive or negative catalyst for the market?
I think that it's going to be a positive, because we have lowered expectations and we are seeing some really good, ingenuity in dealing with this terrible market that we've had. However, Carolyn, the fundamentals as far as the cost of capital and the free cash flow and unless you have a company that has such a positive amount of cash flow, an Apple, and you're just going to have to go back out into the market, and everything is so much more expensive. We can't pretend we're going to have the same growth factors when cost of capital is, 2.5x what it used to be for these companies.
So we had James Locke on earlier in the show. His S&P price target is 4,100 for year end. Is he being an optimist or a pessimist?
I think he could. I'm going to say that is a really good price point. I think that we will have a pullback because I do expect some economic pain before the year's over.
Okay, so how are you investing then? What would you buy right now?
Right now, I would say, because although the earnings season looks great and it makes you want to just, it gives me FOMO, right? Like what's happening? I still am thinking that the year end is going to, especially with the Middle East crisis situation, I'm going to say that we're still going to stay to the conservative side and be more on the commodity-based side, just to make sure that we're getting some safety and some growth.
So energy.
Yeah. Energy, metals, really safe types of things if we see the Middle East and these things really. I mean, we've got Ukraine, we've got Taiwan. How much more can we take? And this is all on top of, all of these raises and the highest cost of capital we've had in, over a decade.
But are you surprised that geopolitical risk hasn't really had all that much of an impact?
Yes, but
why?
That's the danger, though, Carolyn, because it hasn't, we're going to continue to assume that it won't. And that's what I see all the time. And Wall Street is blinded by the fact that we have been blessed. We shouldn't just assume that it's going to continue.
Okay. Energy, though, what's your call on a recession? Because if you're bullish on energy, is that because of just supply issues or also demand?
I mean, I think definitely could be demand issues. If we're going to have a soft landing, we're going to have higher demand. We're going to be going back into a growth and expansionary period. So we would have more demand there. However, if we get to full-scale war, there's going to be such uncertainty that you're going to see a drop in demand, you're going to see a drop in activity, and the world is going to brace for how it's going to get resolved. So it's really going to depend on which way we really go here.
All right. Well, we really appreciate you breaking down your insights for us.
Thank you
Rebecca,
so much.
Thanks so much for joining me at the desk. That's Rebecca Walser of Walser Wealth Management.